of the Grand Coalition. Good news overall for Europe?
I think it probably is. Clearly, we've been waiting for this negotiation to proceed for some considerable time because, of course, the elections were over 2 months ago. So we've been waiting for the deal to be constructed. I think now that we've got the tenets of that, I think there's a degree of reasonable benefit to the Eurozone as a whole because, of course, political stability in Germany is hugely important, but I think also in terms of some of the constituent decisions that are part of that deal, I think are also beneficial. The increase in the minimum wage, for example, that may well encourage at the margin some increased levels of consumer spending in the German economy, and that of course may well see some small pullback in the scale of the German current account surplus and or for the Eurozone as a whole, and that might just help to take a little bit of the steam or the heat out of the euro because of course the current account surplus has been one of the supportive factors.
Now, speaking of the euro, Hans Redeker from Morgan Stanley says 136 is a sell signal for the euro. We're pretty much there at the moment. What's your view?
Yes, I think so. I think at these sort of levels you could argue that the euro still looks rather elevated. Clearly, as you've just mentioned, we've seen euro-yen trading 4-year highs, for example. Of course, that's as much a function of the weakening trend for the yen as much as it is strength for the euro. But I think at these sort of levels there is scope for a move lower. I think the underlying fundamentals in Europe, whilst improving, are still relatively challenging, certainly when compared to the US. And I think also the key issue relates to the balance sheets of both the European Central Bank and the Federal Reserve going forward. Because, of course, there is a little bit of a liquidity squeeze going on into the end of the year, which could force the ECB to consider additional stimulation via another round of LTROs sooner rather than later. But I think also the disinflationary tendencies that are clearly being fanned in Europe by the strength of the euro also need or require a cheapening in the value of the currency. And I think that is a scenario that we do expect from CIBC's perspective to play out through the course of the next few months. So at these sort of levels, it certainly looks a pretty good value point to sell.
Now, Jeremy, it's interesting you talk about the balance sheets and the LTROs because the ECB's warned about the potential threat and risk from the expected Fed tapering. Do you think there's a real threat to be worried about?
Well, as far as if you're thinking a threat in relation to the performance of the euro, then I think it probably is. Because, of course, one of the real defining factors, or the two key defining factors for euro performance this year has been the resilience on the current account side and also been the deviation in terms of the size of the balance sheet to the ECB versus the Fed. Because, of course, the ECB's balance sheet has been contracting as the LTRO funds have been repaid by the banks through the course of this year. If we are going to see a slower pace of expansion of the Federal Reserve's balance sheet and also, by implication, probably seeing spreads and 10-year yields moving up a little bit further in the US, then I think that does encourage or underline the bias for a weakening value of the euro. Of course, if the tapering were to be seen to be more aggressive than markets are anticipated, that could cause greater dislocation of financial markets. But a steady tapering from the US through the course of this next year, I think will see those balance sheets gradually starting to move closer again, as I say, if the ECB particularly is also forced to do another round of LTROs.
Right.